Are you looking for a way to build a steady stream of income without having to do much work? Well, today we're diving into the world of dividend investing. In this video, I'll break down what dividend investing is and why it can be a great strategy for both beginners and seasoned investors. Hey everyone, if you've been here before, welcome back. If not, hi, I'm Simone, and I'm just an ordinary person who's been investing in property since 2005 and in the stock market since 2014. The purpose of my channel is to document and share with you my investing journey, and hopefully to inspire some of you to invest along the way, and to show you that the stock market isn't really as risky or as scary as some of you might think. Alright, so let's get right into it. So, what exactly is dividend investing? Well, in the simplest terms, dividend investing is a strategy where you buy stocks that pay a dividend. But what does that really mean? I'll break it down. A dividend is essentially a portion of a company's earnings that's paid out to its shareholders. It's like a thank you from the company to say, hey, thank you for buying our stock. Here's some of our profits. Not all companies pay dividends, and dividends aren't guaranteed. Companies choose to pay them based on how much profit they're making and how much of that they want to share with their shareholders. Some companies, like Coca-Cola, Procter & Gamble, pay dividends regularly, while others might reinvest the profits back into the company for growth. So let's say you own 100 shares of a company and they pay $1 dividend per share. That means every quarter, or whatever their dividend schedule is, you'll receive $100 dividend payout. Most US companies pay quarterly, that is every 3 months, and most UK companies pay biannually, that's twice a year. If the company increases its dividend, that is dollar per share, your income from your investment will increase too. In essence, dividend investing lets you earn money just from owning a stock without having to sell them. It's like getting paid simply for holding on to your shares. Well, now that you know what dividend investing is, you might be wondering, why do companies even pay dividend in the first place? Well, there are a few key reasons, and understanding them is important for any investor. First, paying dividends is a way for companies to attract investors. Think about it. If you're an investor looking for ways to earn a passive income, dividend investing can be super attractive. Dividends give you regular cash payouts, and who doesn't want that, right? Second, dividend payments can be a sign of financial stability. Companies that consistently pay and grow their dividends signal that they're generating good profits. It's a way to show investors, hey, we're doing well and we want to share that success with you. Take a company like Coca-Cola, for example. They've been paying dividends for decades, and their ability to consistently make these payments show their investors they're in good shape. They're reliable, profitable, and able to reward shareholders. Third, paying dividends can help improve investor confidence, especially in times of volatility. When stock prices are fluctuating, dividends provide a steady flow of income, which can make a stock more appealing than just hoping the stock price will go up. Lastly, some companies, especially mature ones, may not have as many growth opportunities left. So instead of reinvesting all of their profits back into the business, they choose to reward their investors with dividends. It's a way for them to return capital to shareholders, especially when they don't need to invest it all into new projects. So now that you know why companies pay dividends, let's take a look at the different type of dividend stocks you might come across. Not all dividend stocks are created equal, and there are a few categories to keep in mind when choosing which stocks to invest in. First up, we have high-yield dividend stocks. These are stocks that pay a relatively high dividend yield compared to the stock price. Think of it like a bigger payout, but bear in mind, higher yields often come with higher risks. High-yield stocks might be attractive if you're looking for cash flow, but they can also be more volatile and come from companies in sectors that tend to be more unpredictable, like energy or communications. Always do your homework before jumping into these. Next, let's talk about dividend aristocrats. These are companies that have a long track record of 25 years of increasing their dividends every single year. These are often large, well-established businesses that have stood the test of time. Investing in dividend aristocrats is often seen as a safer bet because of their history of stability and reliability. These companies have proven that they can continue to grow even through tough economic times, and their dividends keep rising. There's also the companies that are dividend kings, companies that have been paying dividends for 50 consecutive years or more. Then we have real estate investment trusts, or REITs. These are companies that own and manage real estate properties like shopping centres or office buildings, and are required by law to pay out 90% of their taxable income in the form of dividends to shareholders. Examples include Realty Income, known as the monthly paying dividend stock, CubeSmart, Agree Realty, and Simon Property Group. There's many more. REITs are popular among income-focused investors because they tend to have a higher yield than most other stocks. But they also come with their own set of risks, like market conditions that affect the real estate sector. And lastly, we have low-yield dividend stocks. These might not pay as high of a yield, but they often come from stable, well-established companies that focus on long-term growth. These are typically considered less risky because of their strong fundamentals. And they might be a good choice if you're looking for steady growth and income along the way. Some examples of these stocks are in sectors like consumer goods, utilities, healthcare, and utilities, where businesses are less likely to experience big ups and downs. Companies like Visa, MasterCard, Home Depot, and Pepsi fall under this umbrella. So when you're looking at investing in stocks, you'll need to consider your investment goals, whether you want high current income, long-term growth, or maybe even a bit of both. Next up, I'll talk about the advantages and disadvantages of dividend investing. Before I continue, I'd just like to take a moment to plug my book, What School Didn't Teach You About How to Get Rich, which I wrote because I'm passionate about helping people to make their lives a little financially better. It's available on Amazon and the link is in the description below. So I thank you in advance if you decide to buy it. Now, let's talk about why dividend investing can be such a powerful investing strategy. First up, we've got the passive income. That regular income can be really useful for covering living expenses. Or you can reinvest it to grow your wealth even more. It's the ultimate in passive income. I much prefer it to property investing for that reason. Next, there's the reinvestment potential. You can automatically reinvest your dividends through what is known as DRIP, Dividend Reinvestment Plan. This is a powerful way to take advantage of compound growth and the snowball effect. The more shares you own, the more dividends you'll receive, which you can then reinvest and buy even more shares. Over time, this compounding effect can lead to significant growth in your investment without you having to put any extra effort in. Compounding is one of the most effective ways of building your wealth. It's like having your money work for you, earning you money on top of money. And why I love dividend investing so much. Another advantage is lower volatility. Dividend-paying stocks are generally more stable than growth stocks. That's because companies that pay dividends tend to be established businesses with steady earnings. While the stock price might fluctuate, the dividend can act as a buffer. When the market drops, you're still getting your dividend payouts, which can provide a sense of stability and reduce the emotional stress of market swings. Plus, during market downturns, the dividends can actually help you to buy more shares at a lower price, potentially increasing your returns when the market recovers. And lastly, dividend investing can be a good hedge against inflation. As companies increase their dividends over time, they can help offset the effects of rising prices on cost of living. If a company is growing its dividend payouts consistently, it means your income from that investment is growing, which helps protect you from inflation eating away at your buying power. Now, while dividend investing has a lot of benefits, it's important to keep in mind that any type of investing comes with risks. Let's take a look at those now so you're fully prepared for this strategy. So let's talk about some of the potential risks that you need to be aware of when it comes to dividend investing. First up, we have dividend cuts. Just because a company has been paying dividends for years doesn't mean that they'll always do so. If a company faces financial struggle or a decline in profits, they may decide to cut or even stop paying dividends altogether. This is especially true in companies that are more sensitive to economic cycles, like energy or real estate. So while dividends can be a great source of income, it's important to keep an eye on the company's financial health and how sustainable the dividends are. Next, there's interest rate risk. When interest rates rise, dividend stocks can become less desirable compared to other fixed income investments like bonds. Let's say the government raises interest rates. Suddenly, bonds offering a higher yield become more attractive than steady paying dividend stocks. This can cause the stock prices to fall as investors look for better returns elsewhere. Another risk to consider is concentration risk. If you focus too much on dividend stocks from one sector or industry, you could end up overexposed to certain risks. For example, if you invest in real estate or energy companies for their higher yield, and the real estate market or oil prices take a hit, your entire portfolio could be at risk. So diversifying your portfolio across different sectors can help protect you from this risk. And lastly, there's tax risk. Depending on where you live, dividend income may be taxed at a higher rate than other types of income. So it's important to factor in how taxes will affect your returns when deciding whether dividend investing is right for you. So, while dividend investing can have many benefits, it's important to be aware of these risks: dividend cuts, interest rate fluctuations, concentration risk, and tax implications. Like any investment strategy, it's important to do your research and be prepared. Now that we've covered the risks, let's just wrap up with a quick summary of dividend investing. Okay, that's it. Dividend investing is a strategy that focuses on earning income through regular payouts from companies. It's a great way to build wealth over time, whether you're looking for passive income, long-term growth, or a bit of both. But remember, like any investment strategy, it requires research, patience, and a long-term mindset. If you enjoyed this video and found it helpful, do me a favour and press the like button and consider subscribing for more content on personal finance and investing. I'd also love to hear from you. Are you dividend investing or considering doing so? Let me know in the comments below. Thanks for watching, and I'll hopefully see you in the next video where I'll be diving into how to get started in dividend investing. Until next time, take care.